Okay, we are going to be working with assignment number 2, which is about retirement. Now, this assignment is a little challenging. We're going to be introducing a couple of concepts that we haven't seen before, uh, but that doesn't mean that we cannot do them. Of course, we can do them, and we will see them again. So it's one of the things that we need to know. So I'm I'm gonna close this tab right here. I'm suggesting you to use this web page Fidelity and pick 5 funds, right? So one needs to be domestic, international sectors, fixed income, and index. You can see the bar right here. It's each of those five different types of funds. So you pick whichever. Let's say blue chip value. I'm gonna open it in a new tab. Then international. Let's say I want to invest in the Nordic fund. Okay, I open it in a new tab. Sectors. Let's say I want to leisure, of course. What else? Fixed income. Now you're gonna pick whichever one you want, right? High yield. Pick based on the name, so based on whatever you think sounds good, right? And for index, I'm gonna pick this one. I'll give you my reasons in just a moment. So I just picked 5 funds at random just for the names. You have plenty of options, so I'm expecting to see a lot of variety, right? So let's take a look at the first fund. And this right here, the overview is basically what it is about. I mean, as part of your project, I'm asking you to justify why would you invest in this fund. Basically, asking you to read this and give me a reason, right? I mean, it's as of right now, I'm aware that most of you might not have a lot of knowledge about the stock market. Nonetheless, you can infer what is or the importance of each fund as you read this justification. I mean, I'm not gonna give you I'm not gonna take off points from what you write, but um, I want you to be aware, right? Because hopefully one day in the future you're gonna be investing your own in your own retirement, right? So you need to know what you're getting into, right? So um, what I would do is copy the name. So I just select it. I have um, well, this is numbers. I'm just gonna copy it here. Obviously, I'm assuming most of you know how to do this. I'm gonna go here to performance and risk, and I'm gonna download the last 10 years. Actually, I'm gonna start with the years, copy and paste, and then I'm gonna go with the returns, copy and paste, right? I'm gonna do the same for the other funds. So the Nordic fund, um, this is actually, I need to copy the name. Um, gonna copy the years, and I'm gonna copy the returns. I want you to notice how bad 2008 was for a lot of the funds, right? That was a very, very bad year. Leisure, right? Who doesn't like leisure, right? I do like leisure, so that's one of the portfolios that we're gonna be working. So leisure, and right here, I mean, you can do this in Excel. You can write your justification somewhere around here. I don't want a treaty. I don't want something extremely long and descriptive. I just want one sentence, right? I just want you to give me a reason. Um, just start thinking of that, right? So this is high income fund. This is a bonds high income. So we're taking kind of like a little bit of risk right here. By the way, in reality, bonds are supposed to be safe. Bonds are supposed to balance any craziness in the market, which basically means that if the market is going up, you go up at a lower rate. But if the market is going down, you go down at a lower rate, right? And finally, we're gonna do this 500 index. Now this fund mimics the S&P 500. We will talk about that later in the semester. But the S&P 500 is one of the most important indices in the market, right? And it is convenient for you to invest in a fund such as this one, because in a lot of the other funds you have someone that is doing research. These are pretty much self-managed. You don't pay extra fees. That's what I'm trying to say. You don't pay extra fees, and well, it could be good for you. So I'm just gonna name this tab performance. Then I'm gonna write a new one. I'm just gonna call it portfolio 1. So what we're gonna do here, it's basically a summary, right? I'm gonna be copying the years. Let's say blue chip. I'm just gonna copy the names: Nordic, Leisure, High Income, and 500. Okay. I'm just copying the names and aligning them to the left. I'm gonna zoom in a little. I'm also gonna copy the returns, right? So we have the returns here. Everything should be pretty straightforward, right? Just copy and paste. Everything is in order, so this should be quick. I want this to be really quick. So there you go. We have all of the returns. Now, I'm just gonna name this returns. We can center it. By the way, work on the format, make it look good. I want it to look good, right? Now weights. Now weights is another concept that we will be discussing through the semester. But if we are investing, we are not gonna put all of the money in exactly the same amounts in every stock, right? We're gonna be changing that. We're gonna be doing different amounts for different stocks. Let's say, for example, I invest half of my money in the blue chip fund and the rest in the other 4. Well, whatever happens to the blue chip fund is gonna affect my returns very strongly, right? We cannot say that a simple average of these 5 is gonna be sufficient. No. Why? Because if I'm putting half of my money in one of these funds, the performance of this fund is gonna be very important to what we do. So I'm gonna copy the names, and I'm gonna add a column called weights. I'm gonna highlight this because this is gonna be an input column. So whatever we put there, it's gonna be changing, and the answers are gonna change. The rest of it, we're gonna type in formulas, and we're gonna let it sit so that Excel does its magic, right? So weights, if we take into account all of our money, we're going to say that we have 100%, right? So weights is basically the sum of all of them. It's going to be equal to 100%. So just to play it safe, I say this is equal to 100% minus the sum of these 4, right? Now in this case, I'm going to change it to a percentage. In this case, we know that we have 100% because we haven't put anything in the other one. So let's say 30, let's say 20, let's say 10, and let's say 20. Okay. Now make sure all of them are positive, right? Make sure all of them are positive. Certainly you can have negative weights. You'll do that in equity investments if you take that class. Now, actually, I'm just gonna post the. So here's the thing. Now, what was our return in 2006? Just for our reference, I'm just gonna write the average here. and we're going to calculate the average of all of this and have them here. This is just for a reference, right? On average, how do they perform? Now, this number right here, it's not true for this portfolio, since we are investing different percentages in different stocks. Therefore, what we're going to have to do is going to have to be multiply our weight times the return, right? Weight times the return, and if this is correctly set, we can drag down and we can get the answer, right? Now, a thing that I strongly recommend is to no, it's not to do that, right? It's to put the dollar sign before the D. We need to lock the column. We're going to click and drag the function because we want to fill up this table. These numbers are going to change for every fund and every year. However, the weights are not going to change. The weights are going to change based on the line, but not based on the column. Therefore, we need to lock the column, right? The column is always going to be the same, but the line is going to be changing. We put the dollar sign in D. Hopefully, you remember that from business analytics. Okay. You see the numbers don't change, but everything's the same. Now, if we, yeah, it's better if I get everything and click and drag. Boom, right? All of the formulas are working, right? So you see, we keep the column, we change the lines, and then this is consistent. 2009 leisure, 2009 leisure. Perfect. I would go and select everything and reduce the number of decimals. I will leave it with 2 decimals. I mean, it's just to make it a cleaner display. So we're going to add something that's called the total. Instead of the total, I'm going to call it the weighted return. That is more appropriate, right? And the weighted return is the sum of this. And we're going to drag. Now, why is this number different than this number? Why is this number different than this number? Well, because we're allocating our money in a different way. We're putting money in a different way than what we did in this. Now, this one assumes that 20% goes to each portfolio. Now, in this one, we have 3 portfolios with 20%, one with 30 and one with 10. Now, if for some reason I decide to change 20, see, the returns are exactly the same. However, we said that we're going to be putting more money into blue chips. Again, this column, this yellow column, you decide how much money are you putting into that. So this is our weighted return for every year, right? This is our weighted return for every year. I'm going to put something, I'm going to calculate the average and the standard deviation. And actually, I'm going to do the same for this right here. So average, we're going to calculate the average of all of the years and the standard deviation of all of the years, right? We can copy and paste the formula here. It should work perfectly. Okay. Which of these 2 portfolios is risky? Well, this is an important thing, and this is where I want you to start thinking, right? If we put 20% in all of the stocks, we will receive an average of 9.5%. Whereas if we put 30% on blue chips and 10% on leisure, we receive 9.02, basically 0.5% less, right? That is a lot of money. If we take a look at the standard deviation, the level of risk, right? The level of risk with respect to the mean and to the observations we have here. This is 20%. This is 20.31. This portfolio right here is riskier than this one and pays you less. Not a smart choice, right? Riskier and pays you less. Okay, now we're gonna make a third table right here. I'm gonna copy all this. Oh, by the way, sorry, I forgot to put the geometric return. The geometric return is a formula that we're gonna be working. We're gonna be working with this formula later. But what it does, it basically tells us what is the average return if we think of it in terms of time value of money. Think of that as our I over Y variable. if we start in 2006 and then in 2010. Now, all of these returns are different, right? All of these returns are going to be different based on the year. However, if we calculate the geometric return, we're going to get a rate in which we can generalize. Right? The way we do that, we add 1 plus our geometric. I will change this into number. Now we click and drag all the way down. And I'm just going to say it's equal to the product of this elevated to the 1 divided by 10. And then minus 1. I change this into a percentage. Boom, right? This formula right here, we're going to work on that. I think it's chapter 8. I think it's chapter 8, so we're going to work on that. But yes, that's the way we do it. We're basically multiplying all of these numbers and then elevating them to the 1/10th, kind of like what we did to find the effective annual rate, kind of analogous. And then we subtract 1 because we added 1, right? And this is the return. So basically, this portfolio right here is the same as if we had a return of 7.65 every year, compounding, right? Just for your reference, we can pretty much copy and paste this here, and we're going to have a return of 8.32% in the portfolio. Well, if we keep if we put 20% into all of the stocks, right? Again, just to prove, boom, right? Excel does everything. Do not change Excel. Just make sure you have this column that I highlighted in yellow and make sure that all of the other formulas are working, right? Now, I'm going to be copying this just to here. I'm going to paste it right here. And I'm going to call this portfolio returns. Now, we're going to be assuming a growth rate, right? This case, I'm going to say that, actually, I'm going to put them. I'm going to say we are going to be growing at a 2% rate every year, right? Now, this is something you are going to decide, right? You're going to decide how much more money do you want to put every year for the following years, right? So right here, actually, I'm going to start with $10,000, right? Let's say, okay, we start with $10,000. Actually, it's going to go here. I'm going to delete all of this. I'm going to delete all of this. Okay. This, what I'm going to do here, I'm going to get rid of the highlighting. And then I'm going to make this equal to this one in here, right? We're going to put a formula for the weights so that the weights don't change, right? We want the weights to transfer exactly from the weights that we have here, so that if we change this, it automatically changes here, right? So that's why I'm getting rid of the highlight. I'm going to put weights here, and I'm going to get rid of the highlight there. So in this new table, what we're changing is we're going to be changing how much money are we adding every year, and we're going to be changing this number right here, right? We start with $10,000 at the beginning of 2010. Now, how much actually, since we're starting in 2010, it's not growing in 2010, right? It's starting at $10,000. So how much are we going to be having at the end of the beginning of 2007? Well, this amount, right? 10,000 and 200, right? I didn't like the format, so there you go, 10,000 and 200. If we click and drag, all of it is changing, right? So we're basically calculating an increase in 2% based on the previous return, right? Now, this is an important thing. How much are we investing in the blue chip fund? 30%. 30% of $10,000, right? So multiply 10,000 times 30%, right? How much are we receiving out of that fund? Well, it's 1 plus this return, right? So in other words, we're going to be investing 30% of 10,000, which is $3,000, and those $3,000 are going to give us a return of 4.60%, right? So no, I changed this to number, and actually going to copy the format for all of the table, and there you go. And actually, I'm going to throw in a couple of decimals, right? Should have done that for everything. Okay. So what are we doing in 2006? We are investing $3,000, which is 30% of 10,000. And this first part right here is 30% of 10,000. And then those $3,000 are making a 4.6% return, right? Actually, go back. Go back. Sorry, we don't take this into account. We take this one into account. 15.34. Actually, just to make sure we don't get we don't make the mistake that I just made, I'm gonna hide this table, right? Okay, that is better. Why are we? The previous table was giving us the return in terms of weight. We're thinking about the total portfolio. Now, in reality, the blue chip fund was the one that made 15%. So we were not getting 4.6, we're actually getting 15%. Boom. Now, what happens if we click and drag this formula right here? Is this working? No, right? First of all, this E33 needs to be E32, right? It's always going to be whatever we have in the first line. So we're going to lock the line. And now it's working, right? We are locking the line. You see, we put the dollar sign in E32. Now, as we move into different years, this we need to change columns, right? That's why we are not locking E. We're only locking 32, right? Now, another thing, we're going to have to lock the weights as well, right? So I will put a dollar sign into D. Same explanation as with the previous portfolio. Now, we are still not at the point in which we can click and drag and do everything quickly. Why? Because we're going to be adding money every year, right? So now the first thing is, how much money do we have? Well, we have this plus 30% of this amount, right? 30% of that amount. And that is going to be multiplied times 1 plus our return in 2007, right? We lock the column here and we lock the line here. And if this is correct, we should be able to do this, and we should be able to do this. Boom, right? It works. So for 2016, we ended up having 37,000. Then we're going to put 20% of this, and everything is multiplied times 1 times the return. Right? Beautiful. Now, what's the total value of our portfolio? Well, it's equal to the sum of this, right? The value of our portfolio by the end of the year, it's going to be different for every year, of course, right? I'm going to make it even larger because these numbers right here are large. Okay. So the value of our portfolio, 11, almost 12,000, 23. Then it went down to 20, then 42. I want you to see the rebound here, right? I mean, from 23 to 20 and then to 42, right? Then 62. yeah, this year was bad. The rest of them were recovery years, right? And that's the value of your portfolio towards the end, right? So we once this is complete, I'm gonna unhide what we have here. Okay, this might take you a little bit of time. We're gonna do this 5 times. Now that's the bad news, right? The good news is that once it starts working, you can just copy and paste and just change the weights whichever weight you want. And everything should change automatically, right? Everything should change automatically. So I'm just going to do 2, and then I'm going to go to a page called Summary. Then Portfolio, Average, Standard Deviation, Coefficient of Variation, Geometric Mean, and future value from 06 to 16, right? All of those are in your paper, right? In your paper. There you go. So portfolio, we just copy the names, right? The average, I'm talking about this one right here, right? The average, let me call it the weighted average. It's the weighted average, right? No, actually, these are not the portfolios. It's portfolio 1, 2, 3, 4, and 5. Yes. The standard deviation. Now, see, I want you to reference it from your sheet, right? I don't want you to copy the numbers. I want you to reference, right? I want you to use formulas. I'm gonna be changing numbers, and I'm gonna be seeing whether well, I'm gonna skip those because I don't have them. Coefficient of variation, standard deviation divided by average. We will see that later. It is just that, and it's written as a number. The geometric, we have it here. Geometric for one, geometric for the other. And then actually, let's see, 06, 6, 07. Okay. We're going to go all the way to 2016, right? And this is also, we're going to be referencing it from the, and since everything's correct, we can just click and drag. Boom, right? Let's increase the size of the columns. There you go. We do the same for this one right here, right? We just click and drag, and that's it. And that's it, right? And that's it. What combination is the best? Okay. How can we say which one is better? I'm gonna hide. Let's just focus on the last year. I'm gonna hide them just for our reference right now. Which of these 2 portfolios is better? Well, this gave us more money, right? This has a better return. It's riskier though. Geometric is also better. Now, is it worth taking the extra risk? This is what determines whether it's worth taking the extra risk. This is how much risk are we taking for 1 unit of return. So for our first portfolio, we're taking 2.25 units of risk for 1 return. In our second one, we're taking 1.99 for 1 return. So this portfolio right here is going to be better than the previous one because of that. You're also going to say, okay, how long did it take for you to recover? Well, 2000, yes, well, we recover really quickly, right? We're also talking about time, and hopefully this is something that is